I think so. I think you have a situation where, look, European credit will be supported by further ECB buying. European companies have been less aggressive than their U.S. counterparts, so that's a good thing from as far as credit's concerned. But, you have tightened significantly. You've also really tightened a lot in the derivative indices relative to cash bonds. So I think there's more vulnerability maybe in the CDS indices than in other parts of the market. But I think on the bond side, I do think the challenge is that the market has raised expectations for the ECB to such a degree at a point where I think there's an open argument that is further easing from the ECB actually tightening policy in Europe, not easing it because of the damage that it potentially does to financial intermediation.
Right, interesting. So that sort of brings us to the reversal rate as well then.
Exactly.
And in terms of the expectations for fiscal, so if the ECB disappoints in the way you've outlined and you see a bit of a backup in yields, could we even see that run further if the expectations around fiscal are satisfied, even though at the moment it seems a long way off?
Yeah, I think so. I mean, currently our expectation of some backup in yields does not assume any meaningful fiscal response, but I think you're absolutely right. I think if you did get that, you would have not just probably better growth in the Eurozone, but you'd have a lot more issuance, and both of those factors would drive bond yields higher. So, look, we still think there's some impediments to that, and that there's a challenge of fiscal policy coming as fast as I think the market would like it, but that would certainly be an upside risk to yields in the region.
So in terms of how you'd position globally then, just talk to me a little about how you would allocate given everything we've talked about.
Well, look, our key call from a global perspective remains being underweight global equities. We moved underweight in early July. The market went down, and then it went back up, and we're currently chopping around, but we still think that that's the right position to hold. I think you're at a point where not only are we seeing kind of yet another growth scare, right? We've had a couple of these in the post-crisis period where PMIs drop below 50, where earnings growth sharply decelerates. We had that in 15-16. We had that in 2011. I think we're having it again today. But that growth scare is happening at a point where I think a lot of the signs of overall cycle health are a lot more stretched, right? The U.S. yield curve is inverted for the first time. It hasn't inverted at all prior to the cycle. So far this cycle, you have a labor market that's much tighter than it's been at any point in this cycle. So I think both of those things, in addition to valuations, which we don't think price in a whole lot of risk premium, are all reasons to be cautious.
Yeah, and, it's funny because things feel a little bit sort of more optimistic in September compared to August as we head into these face-to-face talks in October between the US and China. Do you think the equity market, could be caught wrong-footed by those talks?
Well, that's what we think is the case. Look, I do think this is one of those stories where time and time again, the market's been told that the talks are making good progress, that a solution is kind of just over the horizon, and time again, the market's been disappointed. And so I actually do think that investors should approach that optimism with a little bit of skepticism. And even if a deal is reached, or even if some partial agreement is reached, I think it still leaves an open question of, will that be enough to really encourage more business investment, more business activity? Because I think business leaders, even if it's a partial deal, some agriculture in exchange for something else, I think could approach that saying, look, I still don't have a whole lot of confidence of where this thing will land 12 months from now, 3 years from now, and so I'm still going to hold back on investment and spending. And if that happens, you continue, I think, to have the growth drag that's been with us for the last 12 months.
Just finally, Andrew, your expectations for the Fed from here in terms of the mid-cycle adjustment. Much more rate cuts to come?
So we only think the Fed cuts rates one more time, which would be less than what the market's expecting. And I do think the October meeting is now going to be a pretty close call because, you have had kind of mixed data in the U.S. Ironically, the more optimistic maybe the market gets around trade, the harder it is to justify for the Fed kind of taking further easing action. While we talk all the time about how there's no inflation, core CPI in the U.S. is 2.4%, kind of near a cycle high. So, there are signs, while it's not universal, I think there are signs